Well, all right, we are about a minute past the top of the hour, and we certainly, as I mentioned before, appreciate everybody joining into our webinar here today. Hopefully, we'll give you some useful information that'll help you along in your day-to-day efforts in the commodity business. So, one of the things that I did want to mention here before we get started. Um, you probably will have questions as we go through this. You are certainly welcome if you would like to save those questions till the end. However, what I think our preference would be, because sometimes it's easier to explain something in context while I have the slide up. If you have a question, just go ahead and type it into the chat bar. Martha's going to be watching that. She'll kind of stop me and read the question, and we'll try to answer it right then and there. That maybe makes things, I think, a little bit more interactive. Also, one of the complaints that we have had on past calls, not really a complaint, but I have a tendency to get up and walk around, and that can be distracting because I have my camera on. Apologize for that, but unfortunately, I'm probably going to do it again this time because I'm sitting in a chair too long and my back gets tight. So anyway, let's go ahead and get after it here. For those of you that have been on some of our other webinars, you probably have seen an iteration of this slide deck that we're going to go through today. This is this retooled part. I've probably retooled this particular deck 4 or 5 times in the last few years as things have changed with the biofuel startup, new crush plants starting up, new biofuel plants starting up, changes with the USDA mandates, all those things. There's a lot of moving parts to the fuel part of this, shameless plug intended, I guess. But this iteration of the deck, that the prior iterations have always been food versus fuel. And I renamed it Food and Fuel. Can't we all just get along? Because one of the things that has been very apparent here in the last 2 or 3 years is we've had all these new fuel plants start up, is that somehow the market has managed to find enough feedstock for this ever-growing renewable fuel sector to have what they need, but to also for us in the food side of the business to have the oil that we need to make our different food products. So I don't think that's an accident. I'll get into that why. You guys will probably hear me refer to Mother Market. The market is an incredibly efficient thing if left to its own devices. And Mother Market, as I call her, has a tendency to fix supply disruptions, usually much quicker than we think she's going to do. So you'll hear me refer to Mother Market several times as we go through the slide deck today, but I think that's kind of really one of the major themes that we'll talk about. So when I do a presentation like this, and I actually did this presentation down at the Dressings and Sauces Convention here just a couple weeks ago, and for them and really for the audience on this call, what I really like to do is to try to think about the audience and think about, what do they want to know? What questions might they have? and these are kind of the 4 questions that we're going to sort through today. I mean, not necessarily fuel related, but it certainly helps with the supply side of things. I'm going to answer the question, or at least give you the latest iteration of what a U.S. crops looks like, what a South American crops look like. Part of it is because that's the beginning of our supply part of the equation here with the food and fuel argument. But the other part of it is it's kind of that time of the year. We're kind of wrapping up U.S. harvest right now. I think we got about 91% of our corn harvested in North America. We've got about 81% of our soybeans harvested. Probably wrapped a little bit that's left to go here up in the next 10 days or 2 weeks. We'll have it done by Thanksgiving. So, but I'll give you an idea what those crops look like. We'll talk a little bit about the South American growing cycle, which is just starting as we speak. That second question is really kind of the crux of the slides that I'm going to go through here today. Is this the year? Is this the year that the biofuel wolf, as I call it, is finally at the door and is going to devour our veg oil supplies? I'll get into that. Short answer is I don't think so, but I'll kind of make the case for why. This is really a question that's been on the market's mind, I would say on and off, but for the better part of the last decade, since this renewable fuels program has really gotten ahead of steam. So I'll try to answer that question and make my case for why I don't think this is the year. Third question, what are prices likely to do? I don't normally like to make predictions, and I won't get too far off into that ditch, but I'll at least give you an idea of what I think might happen. That is the question that everybody finally wants to get back to. Cutting right to the chase, that's where the rubber meets the road. What are prices likely to do? To me, that fourth bullet point, that fourth question, though, is the most important. If I've learned anything in my 40 years in the commodity business, predicting what's going to happen is just about impossible. But I think you're better served spending your time trying to figure out where are the risks, where are the potholes in the road. So we'll look at where some of those potholes might be. Try to at least give you a preview of what to watch out for, so that you can spot disruptions more quickly than others in the market. So let's go ahead and get after it just a little bit. First question: what do the U.S. crops look like? Well, not bad, I guess would be the short answer. U.S. crops are maybe a little bit subpar, at least on a yield basis. Both soybean yields and corn yields are a little bit below their trend average, but the reality is the U.S. crops are probably pretty good. Even though yields were maybe a little bit less than expected, I think in reality we probably planted a few more acres than maybe we might have expected at the beginning of the year. Now you might ask, how could we possibly plant more acres? We don't actually have any more farm ground in the U.S. That is a factual and true statement. However, typically every spring, Mother Nature kind of throws some curveballs at us, at least in part of the country. There are parts of the country that might be too wet to get an acre planted. The farmer can choose just to not plant that acre if he doesn't get it in time. There's an insurance component that he could draw on, and I don't want to get too far off into that detail ditch. But this year we had a very favorable spring for soybean planting and corn planting. And therefore, we probably were a little bit more efficient at utilizing the vast majority of that acreage base that we have here in the U.S. So while yields were maybe a little bit subpar, the amount of acreage that we actually got in the ground was maybe a little bit bigger than normal. So at the end of the day, U.S. crops, pretty good shape. To give you the latest update, the USDA, we had our November WASDE at about 11 o'clock today, just a few hours ago. Give you some perspective here. Trendline corn yields are about 180 bushels an acre. Last month, the USDA told us that they estimated the crop at about 173 bushels an acre. Market was looking for a small uptick this time, got a little bit bigger than expected uptick, almost 175 bushels an acre. So again, a little bit below that trend average of 180, but not really too bad. Excuse me. On the soybean front, a little bit of an upward adjustment. I think about 51 bushels an acre, 51 and a half is kind of our trend average. Last month, the USDA said we were 49.6. They jumped that up to 49.9, just under that 50 bushel mark. So according to the USDA, we're going to have about 150 million bushels more corn than they told us that we were going to make last month. We're going to find about 20 million bushels more soybeans than we thought we had that last month. So that's really the bigger reason that you saw markets just a little bit lower to finish the day today. We just got a little bit favorable reports here from Uncle Sam. A lot of you on the call here today probably use some canola oil, so I figured I'd give you an update on the canola stocks. The canola situation, the canola production situation, kind of like the U.S., they had a little bit of a subpar yield, maybe a little bit more subpar than we are here in the U.S. If you look at stocks, if you look at stockpiles or estimated stockpiles at the end of the crop year before next year's new crop starts, this is the current USDA estimate. A pretty snug 1.2 million metric tons of canola seed will be left at the end of the year. That would be pretty snug, probably a tolerable amount, but no safety stocks. The reality of the situation, however, is that we probably have plenty of canola seed. On paper, we're tight. In reality, most of the analyst community believes that we're probably not. What we're hearing from our contacts north of the border is that the Canadian canola crop is probably at least 1 million metric tons larger than the current StatsCan estimate of 17.3 million metric tons. Might be even bigger than that. Exports, even though we've had a little bit of a flurry of activity here lately, probably aren't going to be as big as measured. And so the reality is we're probably going to be just fine on canola stocks. We're probably going to be up here somewhere. just below, just above 2 million metric tons. I know some people are even a little bit higher than that. But the reality is, for those of you that buy canola oil, probably going to see canola price pretty competitively with soy, just like we've had here in this past crop that we just finished up. I told you I'd look at South America. Lots of lines and lots of numbers on this thing. But if you look at the bar chart in the upper left, the USDA is currently forecasting what we would jokingly term the mother of all record crops down in South America. Brazil, farmers down there making quite a bit of money planting soybeans. They made a record crop last year, 156 million metric tons. That too was the mother of all record crops, because this 139.5 back here was the prior record. Mother Nature's kind, we should expand production in Brazil again because of an expanded acreage base. And of course, Argentina, after a horrific drought last year, a 100-year drought, should see their production rebound to more normal levels. What does all that mean? USDA's current forecast is about 30 or 31 million metric tons more soybeans produced in South America this year than were produced last year. That would be the equivalent of adding 20 million acres of soybean production here in the US. So I guess one of the points that I wanted to kind of leave you with here today, when you look at market stocks, should have talked about this when I had the corn and soybean stocks to use numbers up there earlier. Matter of fact, I'm just going to bounce back and kind of make my point here. There's those stocks to use numbers I was talking about. We've been living on the edge of soybean supplies. The Mendoza line there is probably 5.5% of use. So we've had just barely enough soybeans to get to the finish line the last 4 years. It's probably going to stay tight, but look at corn. Minimum pipeline supplies for corn are probably right in here at this 9 to 10% area. And as you can see on corn for the last 3 years, we've also been living on the edge. But the market, mother market, has finally fixed this supply disruption. Not a lot of people that care much about wheat on this call. Maybe there are. Very similar story in wheat. After what we thought was going to be a horrific supply disruption because of the war in the Ukraine a year and a half ago, the market has kind of sorted that out. We seem to have enough wheat in the market. So are we going to have enough beans in the market? Well, I think, and this is one of the things I wanted to leave you with today, we've lived through some insane volatility the last 2 years. 2022 was the most volatile year for soybean oil futures prices in the history of the soybean oil futures contract. The message I wanted to leave you with here today is maybe, just maybe, I think we're one growing cycle away for possibly that happening in soybeans as well. That growing cycle is the one that is just getting started right now in South America. We can produce a crop. I think maybe we could see things relax a little bit, and maybe we could have some markets here for a while that were much more like they normally are, which is, yes, you have some volatility, but not the historic volatility that we have experienced. Now, to get that to happen, we need Mother Nature to straighten out and fly right in South America. We're just getting started with the planting cycle down in South America. They got about 50% of their beans planted, about 2/3 of their corn crop planted. And like I mentioned, I think a minute ago, weather's not been quite as great as we would like it to be. It's not horrible. It's still early. But I think as you look at the risks that you have in front of you, if you're managing a commodity deck for your food company that you work for, or even a fuel company, probably one of the biggest risks we've got, certainly chronologically, probably also in order of magnitude, is the growing season weather that we will experience in South America in the next 4 or 5 months. So that's probably number one on the list. A little bit more about that in a second as well. So let's talk about that second important question. Is this the year? Is this the year that the biofuel wolf is finally at the door? I don't think so, is the short answer. And here's kind of why. There are several reasons that I'm going to kind of talk through here. But one of the things that sticks out like a sore thumb, and I don't think it's a coincidence, is this. And what this is the soybean stocks to use that I've been showing you. On the right-hand side, it's the one I showed you earlier. On the left-hand side, I mean. Well, the last time we fell off the edge of the supply cliff was back in the 13-14 crop year. Not coincidentally, we fell off the cliff because we had a bad bean crop in the U.S. that year. We had a bit of a drought. We didn't produce anywhere near the soybeans that we would have produced if Mother Nature hadn't been so cranky. and we didn't have enough beans. Well, not coincidentally, that's also the last year we fell off the oil cliff. That's the last year we had an acute shortage in soybean oil supplies. The minimum pipeline supplies here, by the way, it's probably about 1.5 to 1.4, 1.5 billion pounds, somewhere right through here. My point is I don't think it's a coincidence that this happened. And what that tells me is that, in a general sense, if we have enough beans in the US, we're going to have enough oil. So are we going to have enough beans in the US? Well, looks like it. That's not a whole lot too many, but that ought to be enough to get to the finish line with one great big if. And that if is if we make a crop in South America. With razor thin supplies, we really can't afford to export any more beans that are in the current forecast. And if South America, remember, Brazil is the largest bean exporter on the planet. If Brazil has a subpar crop, that means the world buyer is going to want to buy more beans from the US. And with a razor thin balance sheet already, any beans that go into the export market above the current forecast are beans that we don't have to crush. If you don't crush the beans, you don't get the oil. That could lead to an oil problem. So if the weather's good in South America the next 4 or 5 months, I think we're going to be fine on oil. Hence the comment I made earlier, the biggest risk that you probably have in front of you right now is the weather in Brazil and Argentina the next 4 or 5 months. You might hear me say that another 7 or 8 times during the course of this presentation. I'm not trying to be redundant, but it's in there for emphasis. So when it comes to bean oil supplies, this is what I call the scary chart. This is the chart that has been used for all the bullish stories that have come out and all those who want to be bullish soybean oil and prices specifically and veg oil prices in general. This is the chart of these gigantic renewable diesel plants that are either already running or scheduled to come online here in the next few years. Blue is the stuff that was online here through the end of last year. And the red is the stuff that's coming online, or it was at least scheduled to come online this year. This is next year. Look at the gigantic uptick in renewable diesel capacity that's coming online. What you see on the right-hand side here is just the plant list and when they're supposed to start up. But if you look at the feedstock that it would take to feed all of this capacity, it is positively terrifying. And if all this capacity were to run, in addition to all the traditionally produced biodiesel capacity that's already online, more on that in a minute, we clearly would not have enough any veg oil left to eat. But I'll go through the math here of why I don't think that is really likely to happen. This is a general overview right here of how much soybean oil we have used to make fuel, whether it's traditionally produced biodiesel or the new kid on the block, this renewable diesel. I started this business in 2004. I can remember in 2005 sitting in the boardroom of my first and largest client at the time, wondering, looking at the future, the next year or two, and wondering how in the world were we ever going to find an extra 3 billion pounds of soybean oil to make fuel. We would simply not have enough to eat. The reality is this is the course of the next 15 or so years. We're likely to use over 13 billion pounds of soybean oil to make biofuel in the coming crop cycle. We used almost 12 in the crop cycle that we just finished, and yet we've still had enough to eat. Now, prices are higher. And to quote Bill Lapp, the economist that many of you know, the economist that we work with, his comment to me, he has a way of putting things very simply but very accurately. One of the comments he made to me is, you know what, Dave, he said, I think we would have probably run out of 30-cent soybean oil, but he said we seem to have enough 50 to 60-cent soybean oil. The market, again, has kind of found a way to get this all done. So let me make the case a little bit, which will, I think, set the table for some of these slides that I'm getting ready to go through. Of the handful of reasons why I think we will probably have enough feedstock, enough soybean oil specifically, that we will have enough for the food sector. First off, all of this capacity that I just showed you is not likely to run. Now, the renewable diesel chart that I just showed you is probably going to run, but we might not we might not operate all the traditionally produced biodiesel plants that are currently operational. More on that in a second. I got a slide that I want to show you. But that traditional biodiesel is likely to decline while we see renewable diesel go up. I think the tendency is to look at that last chart that I just showed you and go, oh my God, if all that is incremental capacity on top of all the renewable diesel capacity that we're already running, if it's incremental demand, we're all doomed. The reality is it's probably not all incremental. Some of it certainly will be, but probably not all of it. That's part of the case. The other thing that I will show you as we go through the slides here is that we pretty much have stopped exporting. The three big demand components for soybean oil in the US is food, followed very closely now by fuel. And then we typically export, 2 billion pounds, give or take a little bit. We've all but stopped exporting. I'll show you a slide here in a minute that just shows how drastically US exports have stopped. We've also got additional crush plants coming online. I'll show you a slide for that. So again, Mother Market's trying to fix things. Crush margins have been very good. That's Mother Market asking for more crush capacity so that we can produce more oil to feed these biofuels plants. Not only in North America do we have capacity coming online, but not only in the US do we have capacity coming online, but we've also got capacity coming online for canola crush in Canada. And then the last slide that I'll kind of show you to make my case here is imports. Now, we're not importing soybean oil, not likely to import soybean oil. The US coast is guarded by a dramatic 19.1% import duty. It is extraordinarily expensive to import soybean oil into the US, but we can import a lot of other oils at little or no tariff. And some of that is used cooking oil. Used cooking oil has gone up imports have gone up almost 300% in the US. I'll show you that slide here in just a second too. So maybe a little bit of a spoiler alert, but that is how I think we're going to fix this. The other part of this, the demand side, is largely created by the EPA. In case you didn't know, turning vegetable oil into food is not an economic activity. We would be doing none of it without a government mandate and subsidies. You simply can't take something that has a value of $4 or $5 a gallon and turn it into something that the petroleum equivalent is worth less than $3 a gallon and do so economically. The economics are created 100% by government program. That means that we probably aren't going to overproduce the mandated requirement. We will produce just what we have to produce. And luckily, this past summer in June, the USDA actually gave us 3 years worth of mandates. They gave us mandates for 2023, for next year, and for the year 2025. So at least the demand side of this is largely set in stone. So, I tell you that because we've gone the better part of the last 10 years with the EPA either telling us at the last minute or actually quite late what the mandate was for a given year. We've had several years where we've been well into the calendar year before the EPA even told us what the requirement was for that year. So this is a change and this is good news. At least we know what we're shooting at from a mandate perspective for the next few years. So what does that mean in terms of soybean oil use? Now, I don't like to show a lot of what we call an eye chart like this with a whole bunch of numbers on a page. That's why we've got the red box at the bottom. Now, we can make renewable fuel and meet the mandate out of a whole bunch of different feedstocks: soybean oil, canola oil, used cooking oil, distillers corn oil. The list goes on and on and on. Soybean oil is it's the biggest of the feedstocks because we produce a lot of it, but it is also the feedstock of last resort. As I'll show you in a minute, most of these other feedstock choices will get used first, and whatever we can't find enough of those, we will fill in with soybean oil. The red box there is Bill's latest estimate of how much soybean oil it's going to take in each of these next coming crop years that's going to be turned into fuel. About 13.75 billion pounds in this coming crop cycle. But I still think we're going to have enough. It's going to bounce again as we get out into 2025. But again, I'll show you why I think the market should be able to handle it, at least until such time as Mother Nature throws us her next curveball. Here is a chart of renewable diesel margins. And I want you to show you, this is what I was talking about. all of these other things we can make renewable fuel out of will give the renewable fuels producer a better margin than this blue line, which is soybean oil. Now, it's still a positive margin, at least by a little bit. But this is why the renewable fuel producer is going to try to get anything else he can to make fuel out of first. And then whatever he needs to fill out his mandate requirement is going to be soybean oil. Hopefully that makes some sense. So here is the traditional biodiesel capacity. And what you see in this stacked bar here, the blue part of that bar is the baseline. 10 years ago, heck, 5 years ago, we really weren't making hardly any renewable diesel. All the renewable fuel that we were making, all the renewable diesel or the diesel renewable fuel product that we were making was traditionally produced biodiesel. Now, I suppose I should pause here for just a second and try to explain to you what the difference is, because some of you know, some of you probably don't know. You may be asking, what the heck is the difference between renewable diesel and traditionally produced biodiesel? Don't want to get too far off in the detail ditch, but traditionally produced biodiesel is a methyl ester. What that means in English is you can burn it in a diesel engine, but it's not diesel fuel. It'll burn in a diesel engine, but it isn't the same thing from a hydrocarbon standpoint. Renewable diesel, which is largely made by energy companies that are retrofitting existing petroleum refineries, can produce a product out of vegetable oil that is molecularly identical to diesel fuel. Renewable diesel, it's the new kid on the block, but it's also a better mousetrap. Why is it a better mousetrap? Well, it does cost a little bit more to produce. That's the bad part of it. But the reason that it seems to be coming into such favor is because it is molecularly identical to diesel fuel. You don't have to have a separate tank to store it in. You can put it in the pipeline. You can't put traditionally produced biodiesel or blends in the pipeline. And you don't have to blend it at a particular spec. Most engine manufacturers will not warranty the engine if you're putting much more than about 10% biodiesel in the blend. It's kind of like ethanol that we're familiar with our cars. There is no blend requirements on renewable diesel because, again, it's the same stuff as petroleum diesel. So that's why it seems to be the better mousetrap. The reason that I think that this is important to you is you can kind of see it on this chart. Now, you see here on the blue line, the projections are, or at least so far, the amount of soybean oil that we are using, or at least the capacity for traditionally produced biodiesel, remains about the same. And all the growth in this space is coming from the orange bar. That's the renewable diesel capacity that I showed you that's coming online. When you look at what is likely to happen is that I think a lot of this blue is not likely to run. Now, we're still going to make some traditionally produced biodiesel. There are some big soybean crusher refiners that are integrated into the renewable fuel space, the biodiesel space. They are able to produce it for less money. They don't have the inbound freight. A whole lot of reasons that capacity will probably continue to run. I think some of the other capacity might be obsoleted. So while we are expecting the amount of soybean oil to be made into fuel to go up, remember the eye chart I just showed you, I don't think it will be anywhere near as extreme as simply adding that new renewable diesel capacity that I showed you a few slides ago that's coming online on top of the traditional biodiesel. Hopefully that makes sense to you, but I think that's one of the reasons, as I mentioned earlier, that we're probably not going to run ourselves out of soybean oil, at least not this year. So I talked about exports. These are in billion pounds. So when you look at this big thing up here, this is 2.8 billion pounds of soybean oil that was exported. That was a big year. But as you can see here, we typically in the US have found a way to export about 2 billion pounds of oil, give or take, depending on the year. Look at this past year. We're going to export actually probably a little bit less than 400 million pounds, forecast to go down again in this crop year that we just started. I started in this business, in the commodity business, in 1983. Last year's export total of just under 400 million pounds is by far the smallest number I've ever seen in my 40-year career. Matter of fact, we looked back through the USDA data sets all the way back to 1962 and could not find a number that small. So what the market is doing here is the market is simply saying we can't export oil. We have got to keep it here in the US so that we can make fuel out of it. Otherwise, we won't have enough to meet our mandates. This is another reason that we haven't run out of oil yet. And this was not anticipated. Going into last crop year at the beginning, so about a year ago, most of the people here said, well, yeah, we're going to see exports drop, but they really can't drop much below 1.4, 1.5 billion pounds. Boy, were we wrong. Exports have dropped to unprecedented levels because we're keeping that fuel here at home. How did that happen? Well, to be honest with you, the North American veg oil market is an island right now. And by an island, what I mean is veg oil prices in North America are at least, well, a little bit less than this now, but about 10 cents a pound more expensive than every other veg oil everywhere else on the planet. Now, that's a good news, bad news thing for a lot of you. The bad news is obvious. Nobody likes to be the guy that's paying the most. But here's the good news part of it for your supply chain concerns in North America. The good news is if you're paying the most, you're also the first guy in line. And what that means is that's another reason that I think you're likely to have enough here. I just simply think that if you're willing to pay more than the export market, mother market will keep that oil at home so that you can have it to make your food products out of. So that would be one more reason. Another reason that I talked about that I think we'll probably have enough oil is because, again, I mentioned earlier, there's a lot of additional crushing capacity coming online. This is a plant list of plants that are going to be coming online here shortly. I think that AGP plant is already running or at least trying to run. Same thing with the ADM plant in Spiritwood. And you see that you got quite a few plants here in the pipeline that are going to come online, and those plants are going to produce quite a bit more oil. When you look at north of the border, we've got quite a bit of canola crush coming online. Matter of fact, we've got a big plant in Saskatchewan that's coming online probably in January of next year that should produce a little over 1 billion pounds of additional oil. I think these plants right here, at least what's starting up here in the near future, in the next 6 months, that's almost another 1 billion pounds of soybean oil that it'll put on the market. So yes, we're going to need more for fuel, but this is another way that the market is fixing it. This is another way that the market is saying, look, we'll find enough oil. Here's that plant list, just shown a different way. It gives you the locations for them, where these crush plants are. Not too surprising. We're actually building crush plants where the beans are. I don't know that that's necessarily a watershed comment, but there's where the plants are going to be located. And then if you remember, my final reason why that I thought we would have enough soybean oil. Remember I said soybean oil is the largest feedstock consumed by the fuels market, but it is also the feedstock of last resort. They would rather make biodiesel out of used cooking oil. Now you might say, why would they rather make it out of used cooking oil? Well, for one thing, used cooking oil is typically cheaper. Not so much anymore because of the government program, but it's still more economical to make fuel out of used cooking oil because in the state of California, which has their own program, they will give you more carbon credits for making a gallon of biodiesel, believe it or not, out of used cooking oil than they will for making it out of soybean oil or canola oil. The state of California believes, correctly so, I suppose, that used cooking oil is a waste feedstock. Now, it kind of is a waste feedstock, but we weren't actually hauling it to the dump. It was actually going into the animal feed market. And so we're not only migrating a lot of the feedstocks that we used to feed to animals as an energy source are now migrating over into fuel production, but we're actually importing used cooking oil. I don't want to get too far off into the politics of all this, but it was pointed out to me that actually I had somebody say, do you mean to tell me that we are bringing boats, large boats that burn diesel fuel of used cooking oil from the Far East to the U.S. to be turned into biofuel in the name of reducing carbon emissions? Well, the reality is that is exactly what's happening. But if you look at this column all the way to the right, again, I will apologize for the eye chart, but these are monthly imports. Each one of those is million pounds. So that's 42.3 million pounds. Look at what the imports of used cooking oil have done. Year to date, now this is a month old, but if you looked at the current data through September, we are up almost 300% on imports of used cooking oil. Matter of fact, the last 2 months, August and September, we have set new monthly records for monthly imports of used cooking oil. When you look at this on an annualized basis, believe it or not, it is about 1.5 billion pounds of additional product. So if you remember that eye chart I showed you about 10 minutes ago with how much more soybean oil we're going to have to use and how much more feedstock we're going to need to run all these plants, it's not all going to have to come from soybean oil, and that's kind of the point. We're getting some of it's going to be soybean oil, but it's going to come out of the export market. We're also importing feedstocks, other feedstocks that we can use so that we don't have to use as much soybean oil. So while we do believe that soybean oil used to make fuel is going to keep going up, soybean oil doesn't have to carry all the load. That's kind of the message that you see here from us. So let's go now to the next question, the ever important, what are prices likely to do? Well, I'm going to use one of Bill's favorite lines in this. Bill would tell you, I think he calls it a commodity analyst union rules clearly state that you are not required to give a price forecast in the time frame in which that price forecast will be achieved in the same speech. So a little bit of a disclaimer there. So where are prices going? Well, Bill's forecasting that prices are actually probably cheaper than they need to be right now. I would agree with that. Bill thinks we will have a crop year average closer to 60 cents than closer to 50 cents where we are now. I always also think that when you're looking to answer the question, where are prices going? I think it's also important to ask the question, well, where have prices been? And this is the last few years of that question. Right here, this big run up that we all lived through a couple summers ago, this is when the first big renewable diesel plants came online. Prices jumped again in early months of 2022 to the highest futures price ever. And then markets fell off. Why did prices fall off? Well, this is kind of when the USDA was telling us that we didn't have to use quite as much biofuel as we were expected, as the market was kind of expecting. We've now run back up. I should have probably updated this chart. We are now right down here around this 50-cent mark. And what do you see when you look at this? What I see is a market that 50 cents seems to be a pretty good floor. I don't think that's a coincidence, and I think that that's probably likely to continue. What does that mean? Well, that means when markets do get oversold, as they have been again here recently, and they stick their head below that 50-cent mark, that's probably a pretty good value. It seems to be a good value for food companies especially. Is there risk that this market could go into the low 40s? Certainly there's risk. But I would put something much below 50 cents kind of in the possible, but in my opinion anyway, not likely. So I guess at this point, that's probably about as far out on the limb as I want to go right now. The other point that I wanted to make here is that in recent years, there has been a pretty good correlation between the price of soybean oil and energy prices. Not coincidental, we've got this renewable fuels program that's kind of driving the bus. So generally speaking, as energy prices go up, soybean oil prices go up. Works most of the time. What does that mean to us from a risk standpoint? Well, we've got a war going in the Middle East right now. Energy prices reacted, they went up. But so far, that war in the Middle East, while it is a humanitarian crisis, has not really affected global supply chains for energy yet. Now, I don't know whether it's going to or not, to be honest with you. I'm not smart enough to predict geopolitical events. Not sure anybody else is either. But if this war would spread into an OPEC producing country or a major oil producing country, and or disrupt shipments from one of those countries, you could see crude oil prices spike pretty quickly. It was just a couple weeks ago that we were over $90 a barrel. You see $95, $100, $110 a barrel petroleum prices, I will all but guarantee you we're not going to be 50 cents on soybean oil futures anymore. So that's another risk to put on your risk radar screen. Geopolitical risk in the energy markets probably equals higher prices that you're going to pay for bean oil. So something else to keep an eye on. So now let's talk about the risks. Let's look for those potholes in the road. What is likely to change that outlook? What are things that we need to watch out for? Things that would cause us to have certainly significantly higher prices or significantly higher prices. Well, you see the first bullet there. I've already talked about that. I've already said South American weather the next 4 or 5 months is probably the first and biggest risk that you have on your plate right now. There, I just said it again for emphasis. That is number one. That's number one with a bullet right now when it comes to your price risk. So we're watching that weather real closely. It is early. Mother Nature's not exactly flying the way we'd like her to fly in Brazil, but we still have time to rectify the situation. But that's what you want to watch. When it comes to the mandates, the second bullet there, RVO, by the way, stands for Renewable Volume Obligation. That is renewable fuels jargon for basically the mandated gallons as set by either the federal government and or many of these states like California have their own program. They don't all add on top of each other. They all nest together. But the good news is we kind of know what those are. We kind of know what those are. And based on the mandated volume, we should be able to have enough so long as Mother Nature doesn't deal us a production shortfall in South America this year or a production shortfall in the next crop cycle here in North America that will start next spring. Obviously, we'll start planting. But there are still some additional risks. And you see this first sub-bullet there. Will these renewable diesel plants respond rationally to negative margins? We don't need all this capacity to run, as I've mentioned earlier. And so the market has moved, Mother Market has moved to take some margin away. But the other thing that we've got to remember is that most of these new big renewable diesel plants on that plant list that I showed you earlier are all owned by financially well-heeled, very large energy companies. And so they're not likely to turn the spigot off the first time margins get negative. So how quick are they going to respond to negative margins? I made the comment earlier that I think that we will not over time overproduce the mandate over a longer period of time, but in a short period of time, because of the way that these companies are financed and they've got a lot of money, they probably aren't going to initially turn these plants off the first time margins get a little negative. So that's something to watch that could cause us what I would believe more of a short and medium term type supply disruptions possibly. But we just have to wait and see how this is going to go. Soybean oil values, are they going to continue to be affected by energy prices? I think the answer is absolutely yes. Hence the comment I made earlier. Big jump in energy prices is going to cause you a big jump in soybean oil prices. Is energy going to go up? I don't know. Outside of a geopolitical event, I'm not really bullish energy. I think energy could continue to soften up. Why do I say that? Well, history tells us that when you have economies that are slowing or going into recession, that's not usually bullish energy prices. The Chinese economy has structural issues right now. They are the second largest energy consumer on the planet. Guess who's largest? Us. Our economy is still growing, but almost all the economists that I'm aware of believe that that growth will slow. Whether we go all the way into a recession or not, I don't know, but slowing growth in the US also is not a recipe for strong energy demand. So because of that, I think that energy prices could continue to moderate a little bit. We've moved down into the mid 70s. That feels better to me. We still have some risk in there because of the war going on in the Middle East, but if energy prices were to go lower, they could cause bean oil prices to relax just a little bit more, probably not a lot. It's that upside risk that I would worry about on that one. And then I've got that last bullet. Will increased imports of low CI feedstock displace soybean oil? Absolutely. I believe that probably will. The reason I have the or there is that it has been an industry belief, at least by some that maybe want to be a little bit more bullish, that the USDA will crack down on some of these UCO imports, used cooking oil imports. Why would they crack down on them? Well, there's also a belief in the industry that probably all of that's not used cooking oil. Used cooking oil values have been run up dramatically because of the demand from biofuel and because the state of California will give you more carbon credits for making a gallon of fuel out of used cooking oil. Because of that, you could actually, believe it or not, economically import fully refined palm oil at prices that are far lower than used cooking oil prices in the US. I know that makes sense. Doesn't make sense, but it's because it's a government program. That is what has allowed that to happen. Some people believe that we are actually seeing imports of stuff that is called used cooking oil that actually isn't. Um, Many thought the USDA has said they were going to look into that and they were going to possibly crack down on it. However, like I mentioned earlier, the last 2 months of used cooking oil imports have been record large. So that is still, I would say, an open item. China is also an open item. Chinese economy has been struggling. That's actually maybe good news for you guys as a soybean oil buyer, because China is the largest soybean importer in the world, and it's not close. China imports about 60% of all the beans that trade in the world market. Not all the beans that are produced, but all the beans that are exported in the world, China buys 60% of them. So goes the Chinese economy to some degree or another, so goes the price of soybeans. And so goes the price of soybeans to some degree or another, so goes the price of soybean oil futures, which you do care about. U.S. dollar, will the U.S. dollar remain strong? Will it remain the best looking pony in the glue factory? What we mean by that is you would think with all the deficit spending that we would have, you would think with an economy that's slowing, our dollar would not be so strong. Well, everybody else in the world seems to be having problems too. U.S. dollar value, U.S. dollar is pretty expensive right now. And when it comes to commodity prices, that's also good news for you. A strong dollar generally means cheaper and dropping commodity prices. It's that rising and falling tide that can lift and drop all boats. If that stays the case and the US dollar remains strong, I think that also bodes well for maybe prices relaxing just a little bit here as we go forward. Palm oil production. Now, you may say, I don't use palm oil. Why do I care about palm oil production? Here's why you should care about palm oil production. Palm oil is the largest produced of the world veg oils, and it's pretty wide margin. Soybean oil is number 2, canola oil / rapeseed oil is number 3, but palm oil is the Big Mac daddy when it comes to world palm or veg oil production, and we have an El Nino. When you have an El Nino, you have a larger chance of having drier weather than you would normally have in Asia. Most of the palm oil in the world is made in Malaysia and Indonesia. It's already started to get a little bit dry in Indonesia. Now, if it's too dry on a palm tree, it produces less fruit about 6 months from now. So it's not a problem right now. Do we have a bullish story for world veg oil prices next year? It's possible, but we also have plenty of palm oil today. So you have plenty of palm oil today. That's keeping prices down today. I already told you that world veg oil prices are already way below the US. I don't think this is a huge risk, but it is something that we do need to watch, because if palm oil prices do go up a lot, it could start to push US prices. And this is the island I was talking about. One of the things that will also insulate us a little bit and make sure that we have enough supply and maybe insulate some of this crazy price volatility we have seen the last 2 years is simply that we're already the most expensive market in the world. And again, this goes back to the good news, bad news comments that I made to you earlier. Yeah, we don't like to be the guy that's paying the most, but there is some level of insulation that comes along with that. You're most likely to make sure that you have supplies, and it also might take a little bit of price volatility out. So that is how our crystal ball is working right now. That is how we see things. Hopefully this has been helpful to you. Here's our contact info. If there's anything that we could do for you, if I have any questions that come up after we end this webinar today, please don't hesitate to. You can pick up the phone and call us if you like, or we'd be glad to hear from you in any way. Here's all our email addresses. So, does anybody have any questions that they would like to answer before we end the call? Do I see one there?
Here's one, Dave.
Yeah.
What is the timing, or when do we cross the red line on South American weather if it were to become a real problem?
That is an excellent question. We should be about 60% planted on beans in Brazil. We're currently about 50% planted. If we don't see things straighten out and kind of fly right here in the next 30 days, then I think the market will be much more aggressive in handicapping that. You saw soybean prices actually went up about 32 cents a bushel It's only a little over 2%, 2.5%, something like that last week. Most of that reaction was to this persistent, 30 days ago, even 2 weeks ago, the market was kind of saying, yeah, it's not perfect, but it's early. Well, now the calendar has rolled over to November. Market's a little bit more concerned about it. The calendar rolls over to December, a month from now. If we still have these weather problems that we're dealing with right now, it will be a much bigger deal to the market. Good question. To give you a little bit of crop perspective here, we're planting in Brazil. We will harvest most of our beans in Brazil in January and the first part of February. We're just getting started planting in Argentina. We will have that crop will come off in March and early April. Any other questions? You getting some other ones popping up there, Martha?
Yep, here's one. Are we clearly now in a new paradigm where a 50-cent oil is the new bottom and 30-cent or below oil is now a distant memory?
Can you guys hear me okay?
I can hear you.
Okay. Yeah, I switched from my headset because the battery's about to die. Short answer, yes. Short answer, yes. I think the renewable fuels policy in the US and North America as a whole has really changed the prospects for what we consider to be cheap. The old mean, the 10-year mean prior to that renewable diesel or that run up that I show you in price that we started to see in 2021, the 10-year mean before that was 35 cents. Commodities are mean reverting, which means you would expect to revert back to the mean. I think this is a new paradigm in veg oil prices. Where is the new mean? I believe the new mean, if you look at the data sets, and some of you have already seen the data sets that we have run, we believe the new mean at this point is closer to 55 or 56 cents than 35. So yeah, I think that if you're holding out for 35-cent veg oil, might be holding out a while.
And here's one. Does Stats Canada have a WASD type report?
They will give a no. They don't do monthly updates like the USDA does. They're a lot more intermittent with their reporting. I'm gonna diss on Stats Canada at all, but just historically, their reporting and their estimates are not typically nearly as accurate as many market estimates, or certainly what we become accustomed to with the USDA. And I'm not saying that the USDA is always perfect, but yeah, StatsCan is a lot less consistent with their reporting and a lot less accurate, generally speaking. Did I see another one or two pop up there, Martha?
If the U.S. has enough soybeans, it will have enough oil. With expanding crush refining capacity, how will the U.S. get to having more beans? Grow more, take more acres from corn, import more?
Great question. Probably not import more. We will probably, as I showed you, we've already done, the market has already done in the veg oil market. When we have to, we will do in the bean market. We've got a bean crop this year that is, according to the USDA today, about a little over 4.1 billion bushels. The old rule of thumb was you make a 4 billion bushel bean crop, you export half, you crush half. That's what's going to change. Trendline yields go up, so we will produce a few more beans every year just as yields increase. I think longer term, we might steal a few acres from corn, but probably won't need to get too many of those acres. I think you'll see a pretty good size shift in the next crop cycle, however. But I think that 50-50, or what was historically pretty close to a 50-50 crush and export, is more likely to be 55-45 heading to 60-40. So that's the first place the market's going to go. The additional production of soybeans that the world needs, because world demand for soybeans is growing, it's going to come out of South America. Remember the South America slide that I showed you? Mother Market is paying the Brazilian farmer to plant more soybeans, and the Brazilian farmer is responding to those economics. The Brazilian farmer made the mother of all record crops last year, and if Mother Nature flies right, they will beat that record this year. That's where the world's new soybean production is going to come from, because we have to keep our oil and our beans to crush here so that we can run our fuels program. Great question.
And here's another. Brazil is the largest exporter of beans. Argentina is the largest exporter of meal. What can you say about U.S. soybean meal and the increased pricing we are seeing currently?
You know, another great question, and this gets to an interesting topic. One of the items that I have been the most bearish prices has been soybean meal. And the reason that I have been bearish prices is because if you look at the amount of this new crush that we're going to have to run to get the oil, to make sure we have enough oil, Bill's estimate is that U.S. exports of soybean meal for this crop year are going to have to rise by a little bit over 20%. That is a big lift. The reason that prices have run up so far is, and this year could be a tale of two halves, if you will. Exports have been very good. Exports are running, I think, about 35 or 6% ahead of where they were a year ago. Well, you might say, well, you're beating that 20 or 21% increased pace you're going to need, which is true. But it is because of exactly what you point out. Argentina had a horrifically bad crop last year. We are having to up the ante here in a lot of our meals going into the export market the first half of the year. I think when Argentina harvests their next crop, our exports could go to zero quick. So this is going to be a kind of, I think, making hay while the sun shines. But that's why you could have a tale of two halves of the year. Very robust export prices, supporting price here the first part of the year. Back half of the year, it might be hard to export enough meal to keep crush running. So that is an interesting call out. But yeah, that's what I think we're seeing right now. I'm not overly anxious to buy soybean meal prices up here. I think we could see things fall back here pretty quickly. My own bias again. Sorry about that.
All right, we've got one more. When will U.S. corn prices reflect the size of the crop and expected carry-in?
Another excellent question. If you look at the USDA, I think is currently forecasting something circa 16% of use as an ending stocks for corn. Bill's estimate is even higher than that. If you go back and look historically for the last decade, when we've had stocks to use stockpiles of corn that high, prices have been under $4. Now, for the record, I'm not forecasting prices are going to go down to below $4. But it does tell you that prices here in the upper fours are probably too expensive. But here's why they're up here. Because bean prices are up here. Corn prices can only get so cheap relative to bean prices, or they lose too many acres. We talked about the next planting cycle in the U.S. I think we will see some bit of an acreage shift away from corn to beans to get us back to more of a normal ratio. But I think if bean prices were to go down, you would see corn go right down with it. When will bean prices go down? When South America makes a crop, or when the market believes that South America will have a crop. It's this weather, this less than perfect weather in South America right now that's probably holding the soy complex up to some degree. Soybean exports out of the U.S. are quite poor. Soybean oil exports, as I already showed you, are almost non-existent. Why aren't prices lower? Well, I think they will be if we make this big crop and this record crop in South America. But right now, the market has got risk premium built in. Bean crop looks good in South America. Beans drop. I think corn will come right down with it. I think we could see corn prices in the bottom half of the fours instead of the top half of the fours where they're at right now. But you're going to have to be a little patient. The market's going to have to be pretty comfy. You're going to make a crop down south. Another good question. Thank you. All good questions, by the way.
One last one. Do you have an opinion on RIN values as we move ahead the next few months?
Well, I've been doing this 40 years, and if I've learned one thing in 40 years, it's never bet against a trend. And the trend in RIN prices right now is down, and down hard. They will probably find a floor down here somewhere, but we've got RIN values, at least the last that I saw of it last week, that are just a little more than half what they were 3 months ago. So that too is telling you that we are getting to critical mass on all the renewable fuel we're producing, all these new plant capacities. All right. Well, thank you all. Thanks for joining us. I hope this was of use to you. Thanks for all the good questions. And as I always end my calls, be careful out there.